Hello, welcome to our FAQ series in accounting. In today's session, we'll pick up the issues relating to the earning per share, the basic earning per share, and the diluted earning per share. We'd like to understand what are these two, diluted and basic EPS, and how are they calculated, and how are they shown in the financial statement. The calculation of EPS is governed by the accounting standards, so it is mandatory that every listed company is required to show the EPS on their financial statement. Earning per share or EPS shows the profit distributing ability of a firm. It shows the amount available from the current profit attributable to the equity shareholders. So EPS is equal to the profit after tax divided by number of shares. If the company had issued the preference shares, then profit after tax less the preferred dividend divided by the number of shares. Let us take an example. In this case, the balance sheet opening, closing is given. The income statement for the year is given. The profit after tax is 1,68,000 and cash flow statement is given, which is not relevant for computing EPS. So EPS is equal to basic EPS is a profit after tax divided by number of shares, and the number of shares is, in this case, is a capital divided by the face value per share. So EPS is 16.8 rupees per share. Whereas the company declares dividend, which may be much higher, sometime may be lower, sometime the company may not declare dividend. So EPS just shows the profit distributing ability, not necessarily the actual profit distributed, which is reflected by the dividend per share. Now let's see the diluted EPS. The diluted EPS arises whenever the company has some convertible instruments on the balance sheet, or there are certain options or the warrants which has the potential to become shares. Then you have to calculate the diluted EPS. So the diluted EPS is equal to adjusted PAT by adjusted number of shares. Adjusted PAT is a profit after tax adjusted for interest on the convertible debt instruments less the tax benefits of interest. In other words, when the bonds are converted, so there will be no more interest, so interest will be added back or removed, and since interest is removed, the tax benefits of interest are also removed. In other words, the adjusted PAT is equal to PAT plus interest on the convertibles into 1 minus T, that is the tax rate. And what is this adjusted number of shares? Adjusted number of shares is actually the actual number of shares plus the potential shares. And what are these potential shares? The potential shares are those financial instruments which have the potential to become shares in the near future, and they are commonly convertible bonds, convertible preference shares, stock options, and the share warrants. So if these convertible financial instruments are there on the balance sheet, then the potential share will be added to the actual number of shares to calculate the adjusted number of shares. Let us go back to that exercise. So in this balance sheet we have convertible debentures. So convertible debentures are converted into shares, will be converted into shares at the market price of the share, and the market price of the share is 50. So let us find the adjusted PAT first. Adjusted PAT is PAT, profit after tax, add back interest on the convertible bonds less the tax benefits, the tax rate into the interest will be the tax benefits. So this is the adjusted PAT, adjusted for interest and the tax benefits of interest. The adjusted share is the actual number of shares which we already calculated previously. plus the potential share. But the potential shares depend on the process of conversion, and the process of conversion is given as convertible into the market at the market price, and the market price of the share is given as 50. So potential shares is the bond value divided by the market price. So adjusted number of shares is 12,000. Total number of actual shares plus potential share is adjusted share. So the diluted EPS is equal to PAT, adjusted PAT divided by adjusted number of shares. So the diluted EPS is calculated as adjusted PAT by adjusted number of shares, and adjusted PAT has been calculated by adjusting the interest and the tax benefits of interest, and the adjusted shares are calculated by adding the potential shares to the actual shares, and potential shares are calculated by calculating the bond value divided by the market price. So the diluted EPS shows or gives a message to the shareholder that even with existing profit distributing ability, the EPS may fall in near future because of the presence of potential shares or because of the convertible sitting on the balance sheet. So it is an additional piece of information to the shareholders that the present EPS may not continue because of the presence of convertible bonds. So therefore it is necessary for every firm to show both basic and diluted EPS on the financial statements. Thank you very much.